Hello and welcome to another episode of the Finrestra podcast. I am Jan Muschoot. In this episode, I will talk about the sale of HSBC Canada and especially what HSBC can do with the cash it will receive from this sale. But first, let's do a quick recap of the financial news of November. FTX, a crypto trading platform, went bankrupt, and its founder SBF went from being a multi-billionaire to essentially being broke. In the euro area, inflation finally went down a little. Inflation was 10% in November, whereas inflation was still 10.6% in October, and inflation is going down a little thanks to lower energy prices. There was also news from two large European banks, Swiss Credit Suisse and Italian Monte dei Paschi di Siena, both raised capital. In other banking news, and also the topic of today's episode, HSBC sold its Canadian subsidiary to Canadian bank Royal Bank of Canada, one of the largest Canadian banks. This fits into a broader pattern that I, in one of the previous episodes of the Finrestra podcast called Go Big or Go Home. So basically, if you look at where HSBC derives its revenue from, so you can see that Canada is barely 3% of revenue, and it's about 4% of profits, and also 4% of the balance sheet. So banking in Canada is just a small part of the global group that is HSBC. So it doesn't make sense to exit this market because you cannot have the scale you want to be highly profitable. And also Canada has some big domestic banks who dominate banking in the country. So it makes sense for HSBC to exit the market, especially given that they received a good price for it. And this go big or go home strategy is something that HSBC has been following for a few years now. So for example, last year they also announced that they would exit the retail banking business in the US. And also last year they sold, or they announced that they would sell the French retail banking business, which is also about 3% of the revenue, but they cannot compete with the large French banks in France. And then also in November 2022, so this month or the past month, HSBC also sold its bank in Oman in the Middle East to a local bank. And this is not unique. This go big or go home strategy is not unique to HSBC. Because, for instance, last year I did a podcast episode about the sale of Bank of the West by BNP Paribas. So also the French multinational bank sold its US retail banking division to focus more on its core market. And that's also what HSBC has been doing here with the sale of HSBC Canada. So in financial terms, it seems that HSBC has done a pretty good deal because they received 13.5 billion Canadian dollars, which is about 10 billion US dollars. And that's about 8% of its market cap of HSBC Group. So that's actually a good deal. And if you look into the financial statements, they say they will make a net profit of more than $5 billion on this sale, so above the book value. And of course, by selling the Canadian division, this will also shrink their assets by a little less than 100 billion US dollars. So it has a good boost to the capital ratio also of HSBC as a group. So now let's focus on what HSBC could do with the cash that it will receive. Of course, one possibility is just to return it to the shareholders in a dividend. but that's kind of boring. So what I would do is to follow the go big or go home strategy and to go big in the core markets of HSBC. And HSBC's core markets are firstly in Asia, where it's the biggest bank in Hong Kong and also has significant operations in China, India, also in the Middle East and in some other Asian countries. So what we could do with the cash, or use the cash and maybe borrow some more. So the obvious takeover candidate would be Standard Chartered. Standard Chartered is another British bank that is based in London but is mostly operational in the Far East and also partly in Africa and the Middle East. So if HSBC were to buy Standard Chartered, there would be synergies, of course, in the London offices. And well, I'm not sure if they would be allowed to take over the Hong Kong division of Standard Chartered, because maybe HSBC would become too dominant in Hong Kong. But at least buying the Asian divisions would be a huge boost to HSBC in Singapore. And it would also strengthen the bank in China, in India, in South Korea, also in the United Arab Emirates, and also Asian economies like Malaysia, Indonesia, Vietnam. All those countries would contribute to a more or to a higher market share of HSBC, and hopefully also to higher profitability and economies of scale. Now, so I already mentioned that they probably should sell Hong Kong division of Standard Chartered, and I guess they should also sell the African subsidiaries of Standard Chartered, because I don't see a lot of synergies there, and HSBC is mostly focused on Asia and on Africa. So that would also bring in some extra cash, because the 10 billion US dollars won't be enough to buy Standard Chartered. But I think there's a very clear business case to make to purchase Standard Chartered. Another possibility would be to stay in the United Kingdom. So I found some research by Mordor Intelligence showing the market share of banks in the British market. And then you see that Lloyds is the clear market leader, and HSBC is only the fourth largest retail bank in the UK, together with Santander UK. So a possible takeover target would be NatWest, which is the parent company above Royal Bank of Scotland, which is currently the third largest bank in Britain. And so together with HSBC, they would be about as large as Lloyds Banking Group, and so they would be the first or second largest bank in the United Kingdom. So this would definitely provide some economies of scale on its British home market, and would be quite easy to integrate. So I think that makes a lot of sense also from a business perspective. So compared to Standard Chartered, where you would need to do a lot of divestments and integration in a lot of markets, the NatWest acquisition would be quite simple in terms of geography, and you would also only need the approval of the British authorities. So I think that makes a lot of sense as well. And then finally, thinking out of the box, we could also look at Credit Suisse. Now, I wouldn't suggest to buy the entirety of Credit Suisse, although its market cap is so low that with 10 billion US dollars, you could almost buy the entire bank. But what is probably a better idea, if HSBC would buy the Asia Pacific operations and maybe also the Middle Eastern operations of Credit Suisse, So I guess you don't need the entire amount of $10 billion. But by buying the Asia Pacific operations of Credit Suisse, HSBC could strengthen its wealth management in countries like China, but also in Singapore and in other East Asian countries, and maybe also strengthen some of the investment banking operations in Asia. And I think management of Credit Suisse would probably be happy to sell them, because then they can focus more on their core divisions in Switzerland and the Americas, and maybe focus, while now they are a global bank, but they don't have the size that they need to be a real global bank. So these have been three ideas. So HSBC has sold its Canadian division for a lot of money, and so they could either buy Standard Chartered or NatWest or the Asian activities of Credit Suisse. So I'm very curious, of course, what you think. Should they just return the money to their shareholders, or should they buy other banks, or do you have any other ideas? Maybe they should focus on share buybacks. So I'm very curious what you think. As always, you can reach me by mail at jan.muschoot@finrestra.com, or you find me on Twitter. I'm at Jan Muschoot, that's at JANMUSSCHOOT, or you can connect with me on LinkedIn. So if you just type my name, Jan Muschoot, Finrestra, you will find me on LinkedIn. So this has been another episode of the Finrestra podcast. Thanks a lot for listening, and till next time.